All right, good morning, good afternoon, and welcome to everyone who is on the call today. Please feel free to introduce yourselves in the chat function. As some of you already may know, I'm Marian Adake, and I manage all digital events here at Allraise. Before we jump in, I have a few things I want to point out about the webinar. So as you all know, please again use the chat function to introduce yourselves. And while you have questions during the session, please feel free to drop your questions into the Q&A box. I will keep an eye on that, and we'll be communicating with our moderator today to go through some of those questions throughout the session. And this will be recorded, so we will post the recording on our website about 24 hours after today. So keep an eye out for that. And as some of you may know, Allraise is a nonprofit dedicated to amplifying female voices, accelerating female success, and creating a tech culture where women are leading, shaping, and funding the future. I want to take a moment to thank our sponsors who make events like today's possible. They are key to building and amplifying the movement that will rewire the tech and venture capital industry while creating the camaraderie among women and allies we need to move forward. And so today we're really excited to have a conversation with two amazing investors in the community to talk about the fundraising climate of 2021. And without further ado, our moderator today is our senior program manager at Allraise. She supports our pre-seed founders with programs and digital products. She's a former founder, investor, and community builder. Please help me welcome Melissa Moore.
Thanks, Marian. Hi, everybody. Good morning, afternoon, good evening. It's really my pleasure today to be able to sit down and chat with two amazing investors. So I will introduce our first speaker. She's a partner at Lightspeed Venture Partners, a VC firm based in the Bay Area. She invests in Series A and B startups, specifically in EdTech, future of work, FinTech, and consumer products. Previously, she was the GM at General Assembly. Welcome, Mercedes. And our next speaker.
Having me.
Hi. Our next speaker is a general partner at the Venture Collective, a new firm based in New York and in London. Her prior roles include being an operating partner at Primary Venture Partners. She was also VP of People at Sharkbeat. She invests in the pre-seed and seed stage. She's focused on future of work, health, tech, and wellness, finance, education, and sustainability. I see there's some overlaps between what we all like. Welcome, Kat Hernandez.
Thanks for having me.
Yeah. So one of the traditions that we have at Allraise HQ is that we like to start our meetings with an icebreaker question. So I thought it would be fun to kick us off with one. And my question for Mercedes and Kat is, what is one highlight that happened to you in 2020? I know it wasn't a great year for everybody, but I want to start us off with a positive note.
For me, one highlight was just being able to appreciate a little bit slower pace of life. I think so many of us, whether we're founders or investors prior to the pandemic, and even a bit now, we're just going, 100 miles an hour all of the time, 2 or 3 events every evening, traveling 3-4 times a month to, far sides of the globe or other parts of the country. And it was nice to just, have a little bit of a slower pace of life, get back into reading books and into, doing things at home with family. So that it felt a lot more like, in some ways, my childhood, which was nice.
Feel like I should just take that answer and say that is also my highlight. But I think in 2020, I left my my former firm to start TVC. And so I think for me, the highlight was around having the courage to do something, particularly when the world was like so insane and crazy in a lot of ways. And I think I have an appreciation and a further appreciation for founders who create in like the chaos that is like pre-seed, seed, or Series A type businesses.
Awesome. So on the same vein, in terms of slowing things down, I think my highlight was being able to work remotely and live in Hawaii for 2 months during the pandemic. So that is keeping me going, given that I'm here in San Francisco now. I've been here for a year in our small apartment, but having that 2-month break was really nice. And
You're very jealous.
Yeah. Mercedes' background reminds me a lot of the island. So I'm having some positive vibes right now, just remembering it. All right, so just shifting gears and really talking about the conversation today. I think the reason and the impetus for wanting to start this conversation was I've been hearing a lot on social media that now is a great time to fundraise. When a year ago, I remember attending so many webinars and every VC was saying like, oh, it is a terrible time. Lockdown just started, and everyone was preparing to buckle up for 2020. I'm curious to hear from Mercedes and Kat, like, what was your experience last year when you described the fundraising climate for your firms, and were their predictions true or not?
I can go. I think we talked about this a little bit in prep, but I would say the fundraising climate, the answer I would give would be heavily dependent on the type of business that you're building and the stage that you're at, right? And so early in the pandemic, I don't think anybody really understood how long this would last, what kind of impact it would have on certain industries. And so maybe it was not a great time to build in travel and hospitality, but it was probably a great time to build in other areas. And you were seeing that type of innovation happen in finance or in the future of work in a way that maybe would not have necessarily happened as quickly if we weren't forced into these like new behaviors. The other thing I would say is that a lot of firms, when the pandemic hit, had to look into their portfolios and figure out where they wanted to deploy more capital, maybe preemptively. And so for some founders, it was actually a great time to raise because they were beefing up their balance sheets in advance of maybe having the traction. And I think for certain types of companies, that can be very beneficial if you're being thoughtful about it. And I invest primarily at the pre-seed and seed. So I would say that the pandemic has been it hasn't impacted the early stage investing climate as much as the later stage.
And for us, at the beginning of the pandemic, I'd say in March, April last year, it definitely completely, it was very, very quiet. It's like my email inbox just shrunk up and it was crickets. And I was like, did people not know where my email address is anymore? Like I'm still here. But it was very quiet. And then I think after May, it just came back with a full roar and all the normal lulls and the rest of the year. Like sometimes there's a lull in August, sometimes there's a lull at the end of the year, over the holidays, December. None of that really happened. It just was kind of full steam ahead the entire time. And we now feel like there's now so many companies raising, we can't prosecute and actually look at all of the deals we want to look at. We just don't have enough manpower. And so it seems like everyone's raising and all the companies are doing really well. So I do think it's a good time to be fundraising because the market's hot. It's a founder's market. We're still at a bull cycle. And so, if I would have to raise now versus like think about I was going to raise in 12 to 18 months, I would just go ahead and do it now, if I was a founder.
Awesome. And I'm guessing a lot of people came here to hear just that, Mercedes. So that's great to hear. Like thinking about now, 2021, we're in the early part of the year. I'm curious, Kat, for the seed and pre-seed stages, do you see the same? Like, is it prime time for founders to raise right now?
I think so. I mean, you probably saw similar environment post financial crisis, right? Just like you go kind of through this period of time of like real chaos and people not really knowing what's happening with the economy, and then like it stabilizes, right? And so for pre-seed and seed stage founders that have big visions that are looking to solve in the spaces that we think will have a lot of innovation in the next decade or two, like it's a great time to raise. And you're seeing that in the size of the rounds that are coming together for pre-seed and seed stage companies, right? I think when I started at Primary many years ago, our average check was less than $1 million. And as I left 5 years later, the average check was $2.2 million. And so there is definitely a lot of opportunity for founders to raise capital from people. And so I think the only real advice I have to founders is, because capital is a commodity, is to make sure that you've chosen the right set of partners to help you get through what will be a long, long journey.
And you talked a little bit about the industries. And sorry, Mercedes, did you want to say something about that?
I was just going to say something in terms of the markets being so hot, because exactly like Kat's saying, I mean, the round sizes are getting bigger, deals are getting done at earlier stages and maybe where they would have gotten done a few years ago. And this is both good and bad. I think some of the things that I am witnessing, and I totally agree with Kat in terms of like really being capital as a commodity, so really thinking about the right partner who's going to help you build, because what we are seeing is like a lot of crazy high valuations, crazy high check sizes are getting thrown at founders, but sometimes it comes from capital sources that aren't really going to roll up their sleeves and help you build. And so I think a question is, if they're not asking a lot of questions, if they don't ask any questions about like what's the retention, what's the anything, like I'm thinking about at the Series A and B stage, I see companies asking no questions and say, I'm not going to take a board seat, I'll just be an observer, and here's a check. And that can be good for some, but you also have to stop and ask the question, if they're not asking me questions, how much are they going to really help on the critical business issues? And so I think it's this double-edged sword where I'm really kind of feel for founders. It's a tough, like, to navigate the craziness of the market in some ways too.
Yeah, I want to dig into that. And so I know, I think more than 60% of the founders here are in very early stages in terms of no funding to date or pre-seed. Why is it that raising a larger round is worse? So Kat, you mentioned 1 million versus 2.2, like to a founder that's just like, great, I have more money. But why is that a bad thing for them?
Well, so the one thing I would say is like taking venture money means accelerating expectations and growth, right? And so I think as a founder, you have to think about whether or not you're ready for that, because there is a set of expectations on the other side of that check, no matter how thoughtful the investor is, right? That you will be growing in value at an exponential rate relative to other alternatives in the market, right? And so the question around whether or not you raise one or two or how you make that decision is largely anchored around one, you should think about what you actually need, right? So if you only need $1 million to execute against X, Y, and Z metrics, then like you should think about whether or not that's the right plan. And because the capital like is so readily available for founders out there, the kind of question I always ask is like, are you ready to be valued at 10, 15, $20 million? Because that usually means that in 12 to 18 months, I'm going to have an expectation that you're actually going to be worth that, right? And so you're talking about an execution period that becomes tighter, and depending on your level of experience and your ability to execute well, like you actually don't leave yourself a lot of like room for error. And so that would be my only caution around like the $5 million seed round is like, be very clear on what that means for your business, because I see a lot of companies failing because they can't ever rise into that valuation.
Exactly. It can make the next round, raising the next round, much harder, because exactly as Kat said, now you have to reach that valuation in 12 to 18 months. And if you don't reach it, then people go, okay, well, am I doing it for the next round? Like if the progress wasn't as strong, then is it a down round? Is it in which case you're going to take on more dilution? And so while it might sound better on the maybe ownership or capital stage up front, it can actually have an adverse effect a little bit later. And then the other reason I would give is in terms of, there's that phrase that scarcity breeds innovation. And I have seen time and time again, I mean, I was an operator in startups for 7 years at venture-backed startups. I was a GM leading different business lines. The first thing people do when they raise a large round is, and especially if it sounds like more money than they were hoping for, is they hire a lot of people. And what always happens a little bit later on is like hiring a lot of people doesn't actually always solve the problems. If anything, it creates more confusion about what's the strategy, what's the direction. People are running in a bunch of different directions, and the streamlined focus can become harder. And so I always hear founders saying, the biggest mistake I made was hiring a ton of people right after I raised a big amount of money, because I thought, great, now I have the war chest to go out and conquer the world. When actually with a smaller amount of people, with less money, I would have been much more focused about exactly what we needed to do. So, you know, a lot of founders will say like they came up with their best ideas and their best strategy when their back was up against the wall and they really had to figure it out. Money, I mean, it can make it can give you too many options.
Yeah. And listen, as a former people leader, I've seen it time and time again, right? Resource planning and like business planning is like one of the hardest things to get right, particularly in the early days when you don't really know yet if you have product market fit, if you like, and so because there are so many questions, it's so natural to be like, if I hire 10 people, then this should make it 10 times easier, when like you don't account for the fact that people need time to onboard, you don't really know what you're selling, you're still sorting out pricing, average sales cycle is not something you can confidently like speak to. And so you combine all of that with the chaos of going from like 3 people in a room to 25 people in a room. And if you're not the kind of person that's built teams like that previously, it's really challenging, right? And that's why I think pre-seed and seed stage investors in particular tend to be very strong on the people side of things, because they've seen the repetition over and over again. And I think having investors that understand what it means to build a strong founding team, like have the right dynamics at the table to achieve the 1 or 2 metrics that matter most, not the 10 metrics, is like, it's the difference between success and failure in a lot of cases.
Awesome. And so when we're thinking about like building out the team, whether or not to do that, you know, after you've raised, what are you hearing from your portfolio companies in terms of returning back to the office, given that vaccines are rolling out here in California? I think things are moving fairly quickly, although that might be subjective. But are you thinking that it's going to be a hybrid work model moving forward, or are people resuming, you know, back to the offices?
Depends. I think for some of our startups, especially the smaller, earlier ones, I think that being in person together is something they wanted to do more. But it really is a range. I mean, I'm not planning on going into the office anytime soon. Haven't even seen my office for over a year. And I think that like, we actually are doing a lot of planning with our startups right now in terms of reentry to the workplace and different industry benchmarks. So actually what we're going to be doing, and maybe there's someone we could share this in the future, but we're collecting a lot of the industry benchmarks from our portfolio. I think we'll be sharing those out a bit more about what people's plans are.
I think a lot of people are coming back in the fall, in particular because there's a lot of travel that tends to happen in the summer anyway. So if you reopen an office, you may not get the same like utilization that you expect. My hope is that the world goes back to some version of normal that makes it so that in-person collaboration is not something that you have to think twice about. And if you're a small scaling startup, it is so much more efficient to be right next to the person that you're working with versus having to schedule like very formal calls, right? We haven't yet gotten to this place where I think that that's a very natural thing for people. And so I do think that you miss out on some of that innovation early on that tends to be easier if you're like 10 people sitting in a room together. And so but for the companies that tend to be bigger, there's a question around, you know, whether or not you compel people to come in 5 days a week again. And I don't think you'll see that strong of a point of view on that until we know more about the vaccine and we know more about the impact on the world. I think like flexible work environments are part of why people like to work at startups. And so for as long as a company can make sure that their employees are in productive environments, then, and they can offer them alternatives if they don't have the ability to work from home productively, then like that's a win-win for everyone, right? Because not everyone, I mean, I'm sitting in my living room right now and it's quiet at the moment because there's no 5-year-old. But if there was, it would be a very different scenario.
Absolutely. So let's talk about tactical fundraising tactics and tips. I guess first, we've established that it is a good time to raise, like in terms of this year, but is there also a best quarter, or should people be thinking about like, right, you know, now is good before the summer? And how can founders start preparing for their fundraise process?
Also, one thing I wanted to mention, I saw a comment in the chat about fundraising and remote, just to tie into our last conversation. I think one thing I've been thinking about a lot is like when things go back to being open, what am I going to keep from COVID as relates to fundraising processes versus not? And I think something that I'll probably keep is doing all my first calls on the phone or on video, because it's just too much effort for people to meet up in person if we don't even know if it's going to work out. And in COVID, I maybe saw 5 founders in person total at the very, very end of the stage. And I made about 4 or 5 investments. So it's about the people I ended up investing in, maybe one other. And I think there'll probably be a little bit of creep of that to be a little bit earlier, but I actually think that's a good idea that I would try to keep, is just doing more towards the end. And then to answer your other question in terms of the fundraising process, I think that in terms of when is a good time to raise, there's a couple of like events to think about, which is of course the macro environment, which is what we were talking about. But then there's of course your business and what is the best time to raise for your business, which might depend on the cyclicality of when you see high growth. It's always good to raise on momentum because you're going to control more power and you're going to command the conversation, and investors want to invest when things are looking up and to the right. And so, for example, I'm an investor in some ed tech businesses, and we know for some of them that the peak season is in the spring as the end of the school year, because they're like career mobility oriented. And so people are looking for jobs at that time frame. So it makes sense to raise at that time. I mean, investors obviously know that, okay, you're going to go down a little bit in the summer, given your peak season is there. But what it's helpful to show is to be able to show year over year growth to your peaks. And so understanding where did you get versus if you raised, in a lull, it'd be like, well, what's the next potential? It depends how many peaks you had between. So I think it's always really important to tie your business to your timing as well.
The only, I guess, like one other thing I would add that I say to all founders is like, make sure that you know what the investor is that you're pitching really cares about. And so outside of like making sure that you're raising at the right time for you, so much of the process is managing it similar to the way that you would manage a sales process, right? It's like if you know that Mercedes and I both care about the future of work or ed tech, then like it's a much stronger starting point than like navigating to the wrong person and then ultimately getting a no that will then like cause you to not have that firm as an option, particularly for larger firms where they have many partners and all investors are very vocal about what they care about, what they get excited about. And so I think it's just like spending a little extra time to fine tune that list. And that's what we do with a lot of our pre-seed and seed companies is like, we take the time to kind of walk them through like, here's where we think you might actually have like real success, where you don't have to pitch the version of the future that you're trying to create because they already understand it. You just have to make them believe that it is you that will be able to create that. And I think that's a very different pitch than if you're, sending me something in life sciences that I don't really have any expertise around. I'm more likely to say no to it, even if I like what you're building, because I won't feel like I can add any value to you. And there's a finesse in that process that I think sometimes founders take for granted because they want to get in front of as many people as possible. But actually what you want is like to be in front of the least amount of relevant people.
Exactly. And I would add on to that too. I think there's also sometimes this debate about warm intros versus cold intros. I'm way more likely to respond to a cold email that's super targeted in terms of my interest and what they know about me than a warm intro that doesn't have anything to do with my areas that I'm interested in. I am a big proponent of cold emails that are well targeted and well specified. And I actually think people overuse warm intros. Like when my friend intros me to something and it's not relevant, I'm like, now this is just like hard on all 3 of us. So completely agree with Kat there.
I think I try to like as best as possible, especially on the warm side, I try to like very kindly decline, right? Because the reality is that it's not a good use of time for anybody, right? Or I'm very explicit about like, here are the categories that we care about as a firm. And I'm not sure that this business is going to like cross the line with the rest of our team. And so in the spirit of like not wasting your time, because that's very valuable, you'll never get that back. Like, this isn't a fit. If you still want some high level feedback, then I'm more than happy to offer it. It's just like, everybody's got an opinion. So I don't like to kind of weigh in without really having a lot of information about the business. And so I prefer that they go to people that actually have the, interest and expertise.
I really like that. So here, what I heard was first, like during this time, just expect your initial call to be a Zoom call, just to save everybody some time. Also raise on momentum when things are speeding up. We care about the vertical and then kind of like matchmaking it to the investor's investment thesis. So again, for the founders out there, do your homework. What do investors care about? Look at what they've written, and then make sure that you tailor that. Even if you do a cold email, tailor that to what they invest in. Speaking of momentum, can we talk more about what are the metrics that you look for, right? So like, what are the key benchmarks that you should be showing when you're trying to raise, let's say, pre-seed and seed versus Series A?
They're very different, right? So I'm happy to invest in businesses that have no metrics yet. If I believe that, partially it's the right time to build the business, partially it's a massive opportunity. And also the founder tends to, is coming from a place of like real fit into that category. I'd say like for a lot of our startups that then start to raise Series A, it depends on the company that they're building. And so for some of them, it's about engagement. For some of them, it's about, scalable customer acquisition or some version of that, right? And for a lot of companies, it's about whether or not you can get that distribution in a really efficient way, no matter if it's B2B or consumer, right? Because the worst thing that you can say to an investor is like, I'm just going to buy all my customers on Facebook and Google. And like 20 years ago, maybe that would have been sufficient of an answer, but also because the revenue milestones have moved. And so because rounds are getting larger, the $1 million like ARR mark is no longer, in a lot of cases, sufficient, because so many companies can be built and reach that $1 to $2 million like threshold. It's a function of whether or not you can actually show what Mercedes was talking about, that inflection point, right? So you've figured out the thing that is making it so that you have I guess, like line of sight to $10 million in a short period of time. And for these venture backable businesses, you're talking about, you can't be growing like 5% year over year, right? We're talking about larger growth trajectories, because that's what the industry is built on.
Completely agreed. And I think for Series A or B, the big difference is the metrics. I think the seed, pre-seed is a lot about finding that product market fit from a usage and sometimes monetization standpoint, often a monetization standpoint. And Series A is about scaling up the go-to-market around that product market fit. Okay, we hit it, let's scale it. And so then we do start to look for metrics, because there's a couple of things I'll talk about the consumer side. What we're looking for in investments, really look for like 4 things. We're looking for, does it have the ability to become part of pop culture? Does it create consumer habits? Is there a repeatable, scalable way to grow? And does the founder have a unique insight as to why it's working? And so a lot of times when we find ourselves investing at the Series A, all 4 of those things have to be true. On the enterprise side, it's a lot of the same thing, except for maybe minus the ability to become part of pop culture. And I would say, in terms of what we're looking for from a little bit more quantitative standpoint, we're often looking for 3 to 4, maybe 5x year over year growth in some of your key metrics. We're looking for strong engagement. If you're a product that does DAO MAO, where it's a daily use case, we're looking for, which is often social media messaging, maybe fitness, that type of stuff. We're looking for best in class, around 25-30% DAO MAO. We're looking for strong retention. Obviously, retention varies a lot over different types of products, but for a lot of consumer tech products where there's a subscription to SAL feature, best in class paid, retention is well north of 50% on an annual basis. more in the 60s, 70s%, and also from an engagement standpoint as well. So there's all these like little things that we're looking for. We're also looking for strong unit economics. On marketplaces, unit economics are often upside down around the Series A, but that's okay. That comes back to more the what is the path to strong unit economics, and does the founder really have a strong grasp on what the unit economics are? Are they looking at the business in a conservative way, fully loaded, CAC and fully loaded metrics versus maybe some higher level metrics that might say there's missing out on some stuff in the cost structure. So that's just like throwing out a couple of things to give some examples. I'm also an investor in some enterprise businesses, and there we're looking for really strong like net dollar retention. 120% or better is great, but it's all, all of that is numbers that are rough benchmarks. No one number that I said is going to make your round happen. It's a lot of the, convergence of this and the ability to tell the story of where I am and where I'm going.
That's great. Thank you. I'm going to shift gears and take questions from the audience. So for those of you tuning in, feel free to type in your question in the Q&A section. I know we have a couple here already, so I'm just going to pull some of these questions. I think one from Karen is, as a founder, is it better to launch pre or post launch of a beta product? I think is it better to raise pre or post launch of a beta product might be the question, maybe for Kat.
There's no like singular answer, unfortunately, for this. And Melissa, I think maybe you could speak to this too in your experience around the community fund, right? Like, I guess like if it's a consumer business, a lot of what I think about is how are you thinking about distribution, and is there a wait list that you've either curated to demonstrate demand? Is there a specific part of your background that makes you uniquely qualified to get this in as many hands as possible without it costing you millions and millions of dollars? And sometimes that means like having a highly engaged community is like your differentiating factor, right? And so unfortunately, there's like really no like one answer for that. It just depends on the business that you're building and the product that you're bringing to market. If it's a physical product, there's a lot more complexity around it. But I think, my answer probably still stands true.
Yeah, that's a really great point, Kat. And yes, I'll answer on behalf of the community fund. So this is kind of my weekend hustle where I invest through the community fund, and our thesis is around community-driven companies and how startups that have really nailed the sales and marketing flywheel in terms of building an audience and community will outperform those who have not in the long run. So it's a 5 million fund, and our GPs are Lolita Taub and Jesse Middleton, who is Kat's partner, coincidentally. But I like to think of, as if you're pre-launch, I would say if you have the numbers, like a wait list that is super hard to ignore, that's a 20,000 email wait list, then that is super impressive. And I think it's okay to raise. That's an actual real story that we met a founder who had those types of metrics. However, if you don't have that, then I think it's better to wait and prove that you have momentum and traction. Again, I think investors want to get in on something that's about to kind of accelerate, right? We want you to take venture funding if we know that this is positioned for high growth. We don't want you to raise money just so you can pay your bills and start a business. Like that is not the right time to be looking at VC funding, in my opinion. The other question I have is back to angel networks and investor networks. Are there networks that you two would recommend for founders who are not well connected? How can they find angel investors or other VCs to reach out to?
I can jump in. I'd say angel investors actually tend to be pretty vocal. Like they're either putting it on their LinkedIn profiles or they're in Clubhouse, Upstream, LinkedIn. And so depending on what category you're building in, I would actually spend time just like going through the channels where you think there's a high concentration of tech people, because there's a decent chance that there's a percentage of that community that's also actively cutting checks. Now, it's a function of how many angel investors you want on your cap table early on. And so this goes to the same point of making sure you're very thoughtful about your cap table creation from the get-go, because, you know, every line item is another person to kind of report back to. And so I think for me, the communities that I think are very active is there are a lot of angel investors on Clubhouse. There are a lot of angel investors on Upstream. There are plenty of spreadsheets that are getting getting shared around of people who are actively deploying directly into companies versus like becoming LPs and funds. And so if you're not well connected there, I would just start with like 1 or 2 people and see where that takes you, right? And it does take a little bit of work, unfortunately, but if this is going to be your life's calling, then it's the kind of work that I think is actually worth it.
Yeah, and I would just follow up to say, I think this process of integrating yourself into a new community is actually a really good skill to learn for founders, because you're going to constantly need to be doing it for any new verticals you're launching in, or if you need to hire a CMO, now you're going to have to learn a lot about what the different types of marketers are and how to integrate yourself in the CMO community if you want to get good candidates, or you could have an executive recruitment firm. So I think one thing that I always think about doing is finding and kind of exactly as Kat was saying, like the social communities where they speak a lot. So for me, getting into VC Twitter and founder Twitter was a big unlock of just understanding who everyone was in the industry. And when you combine that with reading like TechCrunch every single day, reading Crunchbase every single day, looking for any insights on when they list who were the early investors, and then starting to pattern match, okay, this person invests in this type of stuff. This early angel seems to always be mentioned in the seed or Series A announcements. That's a good way to start figuring it out.
I agree. I do think that VC Twitter is a real thing. So I think about one of the first investments I made through the community fund, and this woman just had a tweet and then DM me, and her demo and her pitch deck was so compelling that I was like, oh, I want to definitely get on the call. I remember it was a Friday night. She DM'd me and I was like, can we talk tomorrow, like Saturday? And normally I'm like, okay, we don't want to work on the weekends. But then she was just like, let's talk on Monday. And I was just so excited that I just wanted to talk to her. And so for anybody here that isn't connected, I would say like go on Twitter, follow and engage with the VCs there. And if you really have like a compelling pitch and it's relevant to this person's investment thesis and what they've written about, please feel free to DM them or cold email them. A lot of VCs have their emails, I think, on their company websites.
Yeah, they're also very easy to guess. Like, we're not super creative with our emails. It's usually our first name at our firm.com. So, and I'm terrible with like all of the platforms I just told you to go to. I'm like quite terrible at engaging on a regular basis. And so oftentimes I do want people to end up directly in my inbox, because it is just much harder. It's much harder to manage like different pools of communities constantly. And I think I'm constantly missing, I'm sure, great opportunities to connect with people, but there's only so many hours in the day that you can do that. But the only other thing I would say about angels in particular is there are also a lot of angel organizations, right? There are like collections of people that are deciding to co-invest with each other, either because they went to the same school or they have common interests. And so those are also very readily available and easily like researched. And so again, if you're targeting the right person for the right reasons, then you should be able to get a decent hit rate there. And depending on how much you raise, you may be able to get away with your pre-seed having no institutional capital. And that's also perfectly okay. There's like no wrong way to get things going.
Yeah, I want to bring up an important question, which is kind of the elephant in the room, but Brooke mentioned this. She said that she read on DocSend's pre-seed funding report that female-founded companies are doing 3 times more meetings for 60% less investment. So what do you think about that? And what's your reaction, and how can we start creating more opportunities for female-founded companies? I mean, obviously, like Allraise is doing our part, hopefully, to like have these conversations and connecting founders with investors. But I'm wondering, like at your firms, if you're if you're seeing like any initiatives that can level the playing field more.
I honestly think the most important thing long term is going to be having more female investors, because a lot of the research shows you that if women investors are twice as likely to invest in female founders as non-female investors. And so I think that's just a big structural change the industry needs to make. And there's been improvements year over year, but the pace of growth is slow because of just the hiring pace of the VCs. I mean, often they're hiring on fund cycles that are every 2 to 3 years. And so there's not that many chances or opportunities for new investors to join the firm. But that's something that I think like this multiplier effect is the biggest way we can make lasting long-term change.
I agree with that wholeheartedly. And I think if you're pitching a firm that's brand new, it's slightly different than if you're pitching a firm that has been around for a long time and has a handful of female partners. But what I will say about the kind of latter environment is that if you have women in the room, like, it's just much easier then to pitch against that story. And part of the role that I think I played sometimes when we were looking at deals at Primary, where like my two partners at the time, at the time were male, is like just having another perspective, right? And having a perspective around like, hey, for this particular business, given that I may be like the customer or the target, like here's kind of what I think. And it helps to reshape the conversation in a way that hasn't really happened in like prior decades, in part because there haven't been that many women in the room who have been part of the conversation. And so Mercedes is right, it's just going to take a lot of time. And I think also similarly, like as more women rise to the status of LP, and as more endowments and pensions put money into female funds, and those funds tend to be bigger and they can take larger allocations on like cap tables, you will see that statistic change. It's just not going to change overnight, unfortunately. And so the thing I'm very careful about when we look at founders of any kind is just like, how are we assessing them? And are we assessing them in the same way as we are assessing everybody else that walks through this door? And so the bias that we all inherently bring to the table is very real. I have my own set, but I try to be hyper conscious of like how we talk about female founders versus like male founders, for instance. And that can mean the difference between a yes and no decision, right? And if you have that kind of influence in your firm, then you should use that as much as possible. And I think you're seeing more and more of that happen. It's going to take a long time, unfortunately.
I agree with you that we need more women check writers in order to see more diverse founders funded. And so one question was about how to break into VC. So I think all of us have non-traditional backgrounds. I'd love to like hear from Kat and Mercedes, like how did you get into venture, and what is your advice for anybody who's interested into getting into venture?
I got into venture a few years ago. I started with actually impact investing, and I was part of a group that's was Stanford Impact Fund. So kind of like an angel investment network. We were deploying check sizes 75 to 100K. And for me, that was a really amazing introduction. I had a background as an operator who had worked at a lot of ed tech startups. And so the next thing I did was I actually focused on ed tech impact originally. And then I said, okay, let me work at an EdTech VC fund, because although I'm shifting roles and careers, I want to control for not shifting too many things at once. And I think that was actually a smart decision, because I worked at Al Ventures and I was able to go very deep on the kind of content of what we were doing without necessarily knowing how to be a VC. And so I think it helped me get further in my VC career faster. And then I realized, hey, I love ed tech, but I'm also really interested in other things. I'm interested in investing in fintech and consumer and multicultural consumer products. And so that led me to join a more general fund. And yeah, I mean, that is a very short-winded version of it. There's a lot more tactics and tips, and I've written some about it. So there's some writing on my blog and some articles online about how I got into venture if you're curious to learn more.
I'm really terrible at writing, so you will not find any of that on my Medium page. But I think for me, so I spent about a decade operating before I moved into venture. I learned very early on that cultivating relationships, no matter what your role is easily one of the best things that you can do with your career. And so I was fortunate to be introduced to my former partners at Primary through someone I'd previously worked with. And similarly, my partners at TVC, I met through someone I previously worked with, who eventually ended up running the early stage practice at SVB, right? And so it's not that I ever wanted to like grow up and become a venture capitalist. I think my identity evolved over time, and I realized that the kind of investor I wanted to be was more hands-on and more like backing hopes and dreams. And so I ended up where I ended up. But tactically, the advice that I would give you if you are looking to join a firm is to demonstrate your ability to access deals. So no matter what stage of the spectrum you're looking to invest, every investor is looking for some version of proprietary deal flow or some like unique insight that you can maybe bring as a former operator or former founder, or like you're just the kind of person that people kind of flock to all the time. And I have plenty of kind of pockets of deal flow that are people who are trying to build that relationship for the long haul, right? And that is in particular on the pre-seed and seed side, where there's no Crunchbase or PitchBook to be like, looking for deals on. You're looking for great people. And so if you can become that hyper connector, there's a higher likelihood that you can get into the place that will value that network and that community over time.
Thank you, Kat and Mercedes, for sharing your story. I know we're out of time and there are other meetings happening at this time. So I would love to hear from both of you. Like, what are you looking for in your next deal, and what type of founders should reach out to you, and how should they reach out to you?
I am looking for investments in particularly in fintech. I'm super interested in retail investing. I recently invested in a brokerage. So anything in that area, or consumer fintech, neobanks, neobrokers. In edtech, I'm looking for socially driven and community-driven learning experiences. I think this is just a big missing hole at the K-12 side and on the adult learning side. And so I'm slightly more interested in consumer solutions and school sales, but interested in stuff there. And the best way to reach out to me, please no LinkedIn, because I'm like never checking my LinkedIn anymore. It's a swamp now. But my email address is on our website. So email inbox is my best way.
And I would say for me, very similar. I think this last year for me has shown just how much disparity there is in society. And so I've spent a lot of time thinking about healthcare, both on the B2B and consumer side, fintech similarly. And for us at TVC, we spend a lot of our cycles talking about how can we actually improve the lives of the day-to-day American that have, average income that is low, household income that it tends to be lower. And so how can you improve their quality of life is something that we're very passionate about. So we tend to look for purpose-driven businesses building in those spaces. And I'm easy to find on nearly every social media platform. So my LinkedIn is not yet quite a swamp, but I am very terrible at getting back to people there. So email is just kat@theventurecollective.com.
All right. Well, thank you, everybody. This was great. Marian, do you want to wrap things up? Anything else that we want to let our founders know?
No, just a big thank you to everyone. And I sent out a link for, what is it called? The survey feedback. So here's a QR code. Take a quick picture. We'd love to get your feedback. And thank you again, Mercedes and Kat. I learned so much, really appreciated the candidness, and I look forward to seeing your future investments. And thank you, Melissa, for leading the conversation.
My pleasure. Bye, everybody. Have a good Thursday. Thank you.
Thank you.
Bye. Thank you.